Hey, this is Danielle, and welcome to my Earnings in Focus video. So, today I'm going to be talking about Wingstop because I got a comment from somebody on Twitter that said, hey Danielle, I miss the short squeeze tickers that you were highlighting in the options room, and I want to see something that might short squeeze over earnings. So, I did some research and I found this one, and this is going to be Wingstop. So, the reason why this one is on my list is because it is reporting earnings this week. So, it looks like the earnings report is going to be on the 3rd before market. So, that would mean that if you're going to try and get into a trade, you would need to be doing that tomorrow, which is going to be on the 2nd. Now, the reason why this one came up in my research is because, first of all, it is just on my earnings watch list. This is my earnings watch list, which you can find on Twitter at Trader Danielle. But more importantly, the reason why it fits the criteria is because of a combination of factors. Now, when you're looking for a short squeeze over an earnings report, what you need to look for is a stock that is right up near either previous highs or right at highs. Okay, because you want a technical spot on the chart for short sellers to throw in the towel. There needs to be a big enough move for short sellers to say, ah man, this just is not worth holding anymore. This thing could go up to Never Never Land. I got to get out of here. And that usually happens either right around a previous high. So you can see, right around this zone. This is where we had some previous highs. And then you had an earnings gap up and then whoosh, off it goes. You can see also there were some previous highs right here. You have a gap up. It did go higher for another week or so. It ended up falling again, but you see what I mean, right? And then you're trading higher, and then you see how it broke up above these previous highs, and then off it goes again. So this entire chart has just been one big short squeeze, since all the way down here at 67, and now this thing is trading up at 198. So now we're at the point with the stock where it has 9.52% short interest. Okay, so I don't know how much it had before. I don't have historical short interest here, but I would venture a guess that it was a lot higher, maybe 15 or 20%. But like I said, that's a total guess because I don't have the historical short interest. So right here, you're just underneath 10%. Typically, you do want to see, at least 10%, 15% is even better, 20% is even better, 25% is like the magic amount of amazing, short interest for a really big move. But I'll take 9.5%, 10%. Now, the other factor that you want to have is you want to have good fundamentals. And on top of good fundamentals, you also want to have positive moves as it relates to those fundamentals. So it's not enough that the company is beating earnings estimates. You need the company to be beating earnings estimates, and then you also need people to be happy about that and for buyers to come in. So when you're looking at this move, for example, they were estimated to earn 41 cents. They actually made 60. And then on top of that, it gapped up 14%. Quarter before that, they were estimated to make 35 cents. They actually made 45. Boom, gapped up 14.9. Quarter before that, they were estimated to make 35. They made 45. Boom, gapped up 12.4%. Now, obviously, this is the time frame where it all changed, okay? So, you went from down, down, down. You had a major trend shift right here. And now we're onwards and upwards. So short sellers, they made some money in here, but they started giving it all back, right? So when you look at the comparison of these quarters, you can see that they missed slightly by two sentences. Since the quarter before that, you can see they had a pretty big miss there. Quarter before that, big miss as well. So obviously something changed. Wings got better. I don't know what changed. Doesn't matter. But something changed down here. And now we have a bullish trend. Now, when you look at the move going into earnings, one could definitely argue that, hey, the move has already been made. And it's possible, maybe it has, because we came into the hot zone and we just continued trading higher since then. The squeeze already fired. We're already up here at highs going into earnings. So it's possible that, some of the move is already priced in. But here's the thing. It has a $17 expected move. And this is what you need for a short squeeze. You need the expected move to be more than what it would take to make the new high. So if you take 198 plus 17, that's going to be more than 205. So what that means is that if there is just a normal market maker expected move, nothing crazy, right? Like, they did a good job. They sold some wings. They make their expectations. Even in that situation, it would still make a new high. And when it makes new highs is when the short sellers have to buy to cover, and that also sends, more buying pressure. So, it could short squeeze even if it has like not even an exciting move. That's what's cool about those numbers. Now, if you think about, okay, well, what if they did amazing? What if, people were coming out for wings left and right? Well, that's when it gets exciting because, if it does have, let's say, like 1.5 times the market maker move, like let's say it trades higher by about $30. Well, by then, you're definitely going to be squeezing out what's left of those short sellers because if they wake up to, $30 price gap in their face, that's not going to be fun. So, those are, the things that I look for when I am trying to identify a ticker that could really explode on earnings. All these factors together are really what makes a good short squeeze. Now, of course, the question is, okay, well then how do you trade that? Well, there's a couple different things you can do. Number one, you can just not trade it. The easiest, most conservative thing to do is no trade. The reason for that is because there's a lot, well, I shouldn't say a lot, but there's a decent amount of potential short squeeze candidates over an earnings report, okay? But ultimately, the only way that the ticker will short squeeze is if the earnings report is good, right? So, and since we don't know if the earnings report's going to be good or not, then what you can do is you can just wait until the report comes out, and that takes away the unknown quantity. And then what you can do is you can try to trade it for post-earnings move. You can try to, sell put credit spreads. You can try to buy calls, after the report if it is short squeezing. The second option is get into something, more conservative before the report. So the most conservative way to get into a trade like this is really just going to be by selling puts. Now, with this one, it's a little bit more complicated because you only have monthly earnings, or you only have monthly expiration series here, okay? So we don't normally sell puts like 18 days out on an earnings trade because you normally want to sell them and have them expire that same week because what you're looking for is for the volatility to go up and then the volatility to go down, and then you're wanting to, buy back the put credit spread that you sold, and you can't really do that when it's 18 days later. So you can't really do that. So then that leaves you with, okay, well, can I just buy some calls? Well, you can, but the problem is when you do that before earnings, you still have that same, rising volatility problem and crushing volatility problem. And if you buy calls right before earnings, they go up in value and then they go down in value. Sometimes buying calls on earnings will work, and it's usually in the short squeeze or like a Microsoft situation. But, 8 out of 10 times it's not going to work. So this is a situation where it's like, maybe some out of the money calls if you're really feeling frisky. But just know that that is a lotto trade. So what can you do? Well, you can buy the stock. You can buy the stock prior to earnings. then you wouldn't have to deal with implied volatility. But all of these things are, definitely the more aggressive option, because they cost a lot more money, and you're not just dealing with selling puts. So to sum it all up, somebody messaged me on Twitter, asked me for a short squeeze idea. That is what I have for you. And let me know if you have any more questions, comments. You can send me a tweet or comment on something down here, and I will respond to you. I hope you have a great rest of your day, and I will see you in the next video.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me